Hello traders, welcome to the LFB and our global video charting review. This is for the 19th of April 2011. My name's Marco Haig from the LFB Trade Desk. I hope I find you well. We do have to point out that global market trading does involve substantial risk and is not suitable for everybody, and due diligence is required before taking any information from the videos. We do post disclaimers to the website, and we ask that you read those disclaimers before taking any information. The previous session's subscriber client notes were talking about the impact of the downgrade to the US economic outlook, and in specific terms, the move on the AAA rating to negative in regard to debt and what the impact of that would be long term. Question was asked, is the king of currency in the world since the dollar index was developed and the gold standard was scrapped, the US dollar has been used as a reserve currency? And the question was asked as to what are the global chances of that reserve currency being removed and replaced with something, and secondly, and probably more relevant on an intraday basis, as to how that move away from the US dollar will impact global trading patterns. We're looking at the dollar index, we're looking at it on a 1 hour chart, and we've got separators each time that a new 24-hour period starts at 5 p.m. East Coast time, when swap interest is swapped and new contracts, new futures contracts roll over. So each day, each 24-hour period, we generate a dotted blue line, which is the neutral swing point line, where there were as many buyers and sellers in the previous session at that price point. We then have three areas of resistance and we have three areas of support. And it has to be noted that on these charts, we also carry the daily chart simple moving average areas, the 20-day, the 50-day, the 100-day. We also carry a trend line that just gives us an indication, an eyeball, as to whether the market on a trend basis is in the near term moving long or short. Candle colors change. White indicates that sentiment and momentum is on the short side. Blue indicates that sentiment and momentum have changed to the long side. And as we look through all of the global market charts, we'll notice that it's very difficult for the global market assets to move above or below the high and the low of the previous session without getting a full reversal. So it's very difficult to break these support or resistance lines without having a full reversal coming within the next 24-hour period. Prime example, on Tuesday, the S&P 500 rating agencies downgraded the AAA outlook for US debt. That AAA rating being questioned pushed the dollar higher. The dollar index is made up of the euro, the pound, the Swiss franc, the Swedish krona, the Japanese yen, and the Canadian dollar. And against that basket of currencies, not against all of them, but against the basket of currencies, the dollar found buyers. And that was probably in reaction to the drop lower in global equities as well. Because the one correlation that we do have that's holding in regard to dollar patterns is when equities drop lower, the move out of risk is still going into US Treasuries, into US bonds. So out of the risk of equities into bonds. However, that link is getting ever more tenuous every day, and that's about the only link that the dollar's got at this point in time that's holding close to 12-month inverse correlations. The rest of the correlated markets are moving away from the dollar. We are seeing a sustained move away from the safety of the US dollar, and the dollar's not getting sold when the risk markets are moving higher. So we've got a conundrum here. The dollar as the reserve currency, when risk is getting bought, you would expect it to get sold. So when equities are going up, you would expect the dollar to go lower. When risk is getting sold, equities are going down, the dollar's not getting bought to any great degree. We're finding ourselves with a currency that's at fair value. 75.5 looks to be fair value on the dollar index, and it is going to be very, very difficult for any movement in the dollar index in the near term without coming off of a breaking headline, similar to what we saw yesterday. Now, taking a look at one of the components of the global traded market, we're looking at the forward months futures contract for gold bullion. We can view it in the XAU. This gives us a price and a technical read on gold. Over the course of the last 5 years, each 12-month period, gold has been correlated to the US dollar by about 60%. The fact that gold is denominated in general in US dollars globally, you would expect more of an inverse correlation that gold goes up and the dollar goes down. But as we can just see from that dollar index chart, we had a dollar index chart that was just running sideways, doing nothing. But at the same time, we've got a gold chart that's moving higher. So that tells us that there's a move into gold, not necessarily out of the US dollar, because gold's not going directly up as the dollar's going directly down. Gold's not getting bought as a direct hedge on an intraday basis against a falling dollar value. And we've got the same on silver as well. But the really interesting part is that on the near term, this is a 1 hour chart again, you can see periods of consolidation. Gold is the same as the dollar index in that it can't break and easily hold the previous session's highs without having some kind of a pullback, or breaking the previous session high and holding has to come on a breaking news red flag headline. So the nuances of gold and silver to the greater degree are to buy the dips, not to buy the breakouts because the breakouts are getting reversed, but to keep buying the dips. But as we can see on the dollar index, the value of the dollar, gold isn't pressurizing the short side of the dollar. The dollar is still holding that 75 on the dollar index, where with gold testing up at 1500, you would have expected, if we work with the law of probability and historical reads, that the dollar should have been a lot lower. That also then tells us there's a currency war going on over valuations. That the global central banking community and those sovereign wealth funds that are loaded from 1971 through 73, when the dollar index went through its inception, are overweight on US dollars. They are not prepared to see the value of those reserve currencies stripped to the bone in one easy go. We can see the same technical aspect on the most bullish global asset class we've got, which is silver. The breakouts are hard to hold without getting at least a 50% reversal from the previous session's highs or lows, except on a day that a red flag economic release hits. We've got silver now in a buy the dip move, but the same as gold. When we get to the previous session's high, we do get those reversals. So it's now not a case of buying the breakout, it's a case of buying the reversal to support. But the same as silver, not pushing gold lower. When we look at oil, and we use West Texas Intermediate as the most highly liquid asset we've got in oil, sideways chop at this point in time in oil, but still holding $107 a barrel. At those price points, added to gold, added to silver, added to weakness in the equity market, it would have been understandable for the dollar index to have dropped lower, and it's not. So we're going to look at the individual components of the dollar index, starting with euro. 60% of the dollar index is made up of euro dollar. When you go back on a euro dollar chart in history, and we get back before the year 2000, we're looking at the German Deutschmark. That's how strong the German economy is and how relevant the German economy is to the euro. Euro makes up 60% of the dollar index. As euro drops, the dollar index would be going higher. As euro starts to make a little move up, the dollar index will be moving down. However, it doesn't seem that it's the buying and selling of the dollar that's moving euro. Euro, in a mid-term chart, looks to be very closely correlated to oil. It's not tick for tick in the near term. We pull it out on a daily chart and we pull it out on a weekly chart, as we did on Tuesday the 18th global video charting review. You can see that euro seems to be tracking oil and tracking gold and silver moves to the greater degree on a daily basis, and only then making inverse moves away from oil and silver on a breaking news headline, such as downgrade on AAA rating, which pressures stocks, which then pushes the money market towards treasuries, which then empowers the dollar in the short term, which would reduce the value of euro. When oil moves higher, it does look as though euro wants to follow. When gold and silver make their bids to be bought off support, where they're getting bought off the dip, it does look as though that is as much of a major impact on euro as the euro economic outlook. Now, when we look at the pound, the Great British Pound, we haven't got a correlation. The pound makes up nearly 10% of the dollar index, but the pound is no longer correlated to the silver markets and highly uncorrelated to any of the other asset classes we've got. So we've seen euro, 60% of the dollar index, following oil, gold and silver, but not to the degree that it can push the dollar index down in an exact inverse correlation with gold and silver. We've got pound that makes up another 10% of the dollar index going nowhere. We've got the Japanese yen, makes up 10% of the dollar index, which is heavily pressuring the US dollar. So where we've seen weakness in the euro, which is dollar strength, we've got corresponding dollar weakness in euro dollar. The Swiss franc, running sideways, very similar to the Great British Pound, makes up 5% of the dollar index. And then the Canadian dollar makes up about 10% of the dollar index, running flat. So we've got dollar weakness against the Japanese yen, 10%. We've got dollar flat against the Great British Pound, about 10% of the dollar index. We've got the dollar flat against the Canadian dollar, about 10% of the dollar index. We've got the dollar stronger in the very near term against the euro, as oil dropped back to test support, makes up about 60% of the dollar index. And then we've got the Swedish krona, which we're looking again running flat against the dollar. So we've got a real mix. But when we look at these individual currencies as currency traders, we're not able to break any ranges. Breaking the high or the low of the previous session is virtually impossible to do unless it comes off of a news release. Looking at Canadian dollar, the US dollar only found weakness against CAD because of the CPI report that came out at 7 o'clock on this chart, which created a gap lower. There hasn't been any sustainable movement outside of the red flags, and that tells us more and more that the dollar index has found fair value, and this is a case of selling the high of the previous session, buying the low of the previous session in line with whatever this trend is. And when we go sideways like this, cable looks the same, Great British Pound, the Australian dollar looks the same, Canadian dollar looks the same, the Swiss franc looks the same. You've got to be careful that if you're buying at the high, you've got to be selling at the low and closing that position. If you're buying at the low, you've got to be selling at the high. It's a market at this point in time that's not leaving any room for mid-term maneuvers, and the maneuvers that are coming are only the consequence of a red flag release. In other words, bank early, bank often, because now we've looked at the component parts of the dollar, it does make a lot more sense as to why the dollar index is able to hold support, because it does look as though the global market is moving itself out of a dominated dollar reserve and moving into precious metals and commodities as the global reserve.